Okay, we're ready to go. And let's just start one indicator by indicator. And the first thing on the E-mini is, we're offering the 10 module series, and the 10 module series teaches you how to read price action. And price action is not a specific enough tool to get you, it gets you a lot of entries, but it also pulls in a lot of losers. So what we want to do is we want to create additional structure to try to create a filter for us to sidestep those losers. We still want to get some of those winners because we're going to filter out some winners, but when we take a trade, we want to take a really low risk entry. So I'm not really going to be talking about trading methodology, but I'm going to talk about what we look at for our indicators, what we look at for an entry. So I guess in a sense I am. So the first thing that we're going to do is we're going to add market structure. So we're going to add the trend, and we're going to add the moving average colored. And I'm just going to keep the trend at 3, and the moving average colored should be at 5. And then I'll just explain. I'll explain this. And let me make that the default setting. Let's put those in. Now this is simply the 50 is simply a 50 period moving average. It's a simple 50 period moving average. It's nothing complex, nothing sophisticated. The only thing that's a little bit different is that you can see when you get an upslope, it turns green, and when you get a downslope, it's going to turn red, like right here. And when it's flat, it's yellow. And the reason we do that is because the 50 period is a good indicator not only of higher term market direction, but of higher term market momentum. So when this is green, you know that momentum, longer term momentum, is long. Now the 15 is a proprietary moving average. It's a 15 period, but it's not a standard 15. If I put a 15 period exponential or a 15 period simple, they would just crisscross this moving average. And this is not just a moving average, it's really an amalgam of two indicators. So what you're looking at really, when I first started the program, it used to splay at the end like a piece of rope. And all that coding has long since been fixed. But it showed the two different indicators that were combined into this line. And this is a really nice buy-sell line, or the okay to go long or the okay to go short. But it's also indicative of shorter term momentum. Whoops. So optimally, on a long trade, we want the 50 and we want the 15 to be green. Now, what I believe to be extremely important on a long trade is the 15 to cross the 50. And we always want to trade on the same side of this, we call it a modified 15. That really increases the probability of a winning trade, unless you're taking a counter trend trade. And really, we're not talking so much about trading methodology, it's what we're reading into the indicators. When I look at this indicator and I'm looking for a long trade, I want to see the 50 green and the 15 green. I want longer term momentum to be in the direction of my trade. I want shorter term momentum to be in the direction of my trade. And if I have my 15 cross the 50 to the upside, it's really going to reduce the risk associated with the trade. And that's what day trading is all about, or even swing trading. You want to put as many of these independent variables in your direction as possible. You can see right now, Our bias on the E-mini is for a long trade because we have the 15 above the 50, but we don't have really any trend. The 15 is flat, so we have no short-term momentum, and the 50 is flat. We have no longer-term momentum, and this is when the market is more likely to just move and chop. You have to be very, very careful when we're trading with flat 15s and flat 50s. Now, we'll look at the higher time frames in a minute, but let's just look at our trading chart, because until we get a potential entry, you're not even going to look at a higher time frame or look at anything. And right now, with these two flat moving averages, this is when you really want to stand aside. And you can see the price is sitting right on the 50. The candle body has not penetrated it. Just because it shot a wick through doesn't matter. This is not a break of the 50. Now we're on a 5 range. I just want to make sure, and just to make this easier to read, I'm just gonna make the candle body outlines a little thicker. I'm gonna make them 3 and 3, so we can outline them better. Because in Japanese candlestick dogma, the only thing that matters is the candle body, not the wick. So this is what's telling us how much buying conviction and how much selling conviction there is in every candle. It's the candle body. So the 50 and the 50 create market structure in our price action evaluation of the market and are giving us an indication of longer term momentum, shorter term momentum, and they're also giving us nice areas of support and resistance, which are really important. Now let's move into pivots. We have a very unique pivot indicator. A standard pivot indicator, I don't even know how they work anymore because I haven't looked at one in a long time. You can see that the pivot indicator works from candle body high to candle body high. You can see on this swing pivot, it ignores the wicks. Most pivots look at price, and price is not important. What's important is the candle body. So you can see this swing pivot high is taken off the candle body high, and that creates the true area of support and resistance. Now the other thing about the pivots is that they're coded so that they are only going to break when there's a 2/3 candle body close above the pivot. That will break the pivot. You see right here, this is a down pivot, but the entire candle body closed above. And because it did, the pivot stopped tracing. It's gone. And that's really, really critical. It's not a question of price breaking the pivot. It's a question of a 2/3 candle body closing above the pivot. And there are a lot of pivot indicators out there, but as far as we've had a lot of people request just to buy our pivot indicator, but we don't break it, we won't split it off the suite. But that's what makes it so powerful, and that's also a reason why you have to respect it so much, because it's trading right off of a candle body swing high or swing low. Now, just to give you a quick heads up, the market moved up here. Whoops, wrong line. Can't press buttons. And then sellers turned the market here. So we know that right here, there are a lot of sellers. And they're sitting right at that pivot. And they're just waiting for the market to come back up and to turn it again. And a pivot will weaken every time it's hit because there's a finite number of sellers here. When it's hit the first time, and it was hit here and rejected, and any hit of a pivot is just a price coming up to it. Price came up, and then even though the candle closed down, it was rejected. Price came back up and was rejected. So you had two hits of that pivot. Then the third time it was hit, it broke. I mean, the market didn't make a continuation long trade, but when it starts getting hit the third time and the fourth time is when you can anticipate a pivot break. And that's what I do when we trade. So when you see a pivot, if it's a real long pivot and you can't see where like right here, you cannot see where this pivot begins, what you have to do is you have to squeeze the market and see if this pivot's ever been hit before. If it's not ever been hit before, you just can't anticipate a pivot break. And if you had 930 on the open of the E-mini, and this was on 922, it broke the pivot. And we're not going to trade the E-mini open anyway. But on a first hit of a pivot, we have to assume that there are too many sellers sitting here, and there's too high of a probability of a rejection. So now we're adding more and more rules and structure to our trading to try to filter out losers and to obtain entries on winners that have a higher probability of succeeding. Now, the proviso is that we trade with good volume, and that's going to be the next indicator that I'm going to add. And our assessment of volume is very different than everybody else's. I hope this is the right one. Oh, it is. Now you see in the lower right-hand corner what we do. Let's move to the right edge. And I'll take questions when we're done, because I'm just going to go through it. If you have any questions, type them in and I'll answer them. Let me just move to the right edge. Now, let's put in a standard volume indicator. And these are the way almost all of them are. Let's just use volume right off of Ninja. And what this is doing is telling you how much volume is accumulating underneath each candle. Doesn't matter whether it's a time candle, a tick candle, or a range candle. It's simply telling you how much volume is accumulating under the candle, which gives you absolutely no useful information to trade. And here's why. There's two independent variables that go into the assessment of volume here, and that is this. The first independent variable is rate of candle formation. Now, obviously, this is not a problem if you're trading time, but if you're trading tick and you're trading range or you're trading Renko, it is. So rate of candle formation has an impact. We see all the time where there's decent volume, but there's no volatility. So what happens is that we get a volume spike simply because the candle just sits there. And the other independent variable is contracts per unit time. So these both go into how high this bar is going to be. And we can't make an assessment of volume when there are two discrete independent variables going into its assessment. We can only make that assessment when there's one discrete independent variable. So we do that in two ways. In the lower right-hand corner here, Now, this is our volume counter. Now, this is telling us how many contracts are crossing per minute, and we just set it that way. It'll tell you how many contracts, how many shares, how many lots are crossing for any unit of time that you want. Here's our volume. And see, we set it for, this is not it. It's right here. We set it for one, the period is 1, and it's a minute. But if you want to set it for 2 minutes, 3 minutes, 4 minutes, 5 minutes, for seconds, for a week, for a day, those are all units of time. But we set it for 1 minute to give us an absolute assessment of how much volume is crossing per unit of time. And then, in order to help us do a look back, we take off this useless volume indicator and we put in our volume hammer. And that's one of our newer indicators. Now, the volume hammer, you cannot do a look back on, because it doesn't matter if you're on a 5 range, a time, a tick, or a Renko. This is going to create, in real time, a line on the right edge that is making an assessment of volume in the units of time you pick on this indicator. So this is telling us, on a look back period, how much volume is crossing per unit time. Now, volume is always, in this type of way, a retrospective analysis. We can't look ahead and see how much volume is going to trade out into the future. But we can see here that the E-mini is making a move on falling volume, on very low volume. And if you take the crosshair and put it right over the edge, you can see we're right at about 315 contracts. We're really right at this number here. As you can see, this is very, very poor volume today. That's why we didn't get an E-mini trade. And this, I believe, is the only accurate way of assessing volume, because this takes out the rate of candle formation and only assesses volume the way it should be assessed, in contracts, lots, or shares per unit time. And when you see it, when you see that, and that's the way it was yesterday when I took those losers. Never should have taken them. We should have finished with money yesterday. You have to respect that volume. If there's no fuel in the engine, remember all of this is an assessment of market sentiment. And if there's no one driving that sentiment except for 10 traders, you don't want to touch the market, because a small trader throwing in 50 contracts can just stop you out. So right now, on this volume, we'd never touch the E-mini. And we've got an absolute indication. Now, this candle, on a day like today, takes 10 or 15 minutes to close. On standard volume analysis, you get this huge histogram bar. And then when you did your look back, you'd say, whoa, what a big amount of volume occurred. So it's useless on a look back period. So now you can see in real time that we're getting some volume coming into the market right here. And if you look at our chart, I mean, if we get a B and a continuation C, it's a potential trade. Or our bias already, we know from the part of the chart that we've built. Now, hang on a second. And you can see how choppy the market is. So this is how far we've gotten so far. From what we've built so far, you would see that the only thing that we're going to look for on the E-mini right now is a long trade. got the 15 above the 50. We got the 50 flat. We don't have great momentum. And you can also see, too, that we do get some tick differential. You can see how the 50 on my 5 range here is green, and the 50 on my chart here is yellow. And I have a lot of people who call us. The charts are not always identical. And there's nothing you can do about that. There's always going to be a little bit of tick differential from chart to chart. Nothing that can be done on that. Hang on 1 second here. I'm going to put in the second indicator. Or the next indicator. Okay. Next one I'm going to put in market profile. The market profile is a complicated indicator, but I want to explain it to you because it's a very, very important indicator. All right. I'm going to leave the writing in. I'm just going to move over so we can take a look at it without anything else on the chart. Let's find a nice area here during an actual trading period. Okay. I'm just watching the E-mini. Okay, now market profile. Let me turn on the volume analysis. Here's a show histogram. We'll turn that to true. So here's the indicator. Now, I'm going to go into a little bit of a detailed description of market profile, but not too much. We traded without it for a long time, and it's really, really helped our trading. This encompasses 66 2/3% of all volume at price. So you look at this histogram. This is all the volume at any given price on the E-mini. And 66 2/3%, or 1 standard deviation of price, occurs within the value area high and the value area low. So that price, as it approaches the value area high, is pushed to the downside. When it approaches the value area low, it is pushed to the upside. Because in this auction type market where you have people buying and selling, buying and selling, and buying and selling, and a fair market price has been established for the trading instrument, the market wants to keep price in this range. So there's a centripetal force pushing price back into the point of control. And the point of control is always the same on any time frame because it's the single price. You can see it's the biggest histogram bar. It's the price where most volume has traded. And this is where traders want the price of crude or the E-mini to be desperately. So what you get is an attraction to the point of control and a rejection of the value area high and value area low, pushing price back into the middle. This is why the value area high and the value area low creates such strong areas of support and resistance. Now, what we did was we went a little bit further, and there's a critical node. There's a low volume node, and here's the low volume node closest to the value area low. Now, low volume node is the opposite of the point of control. That's a price that traders don't want to trade the E-mini at. But it's a relative low volume node. We want it to be close to the value area low. And this is a relative low volume node. We want it to be close to the value area high. So it's only operational on the right edge. And that's why only on the right edge do you see this. These zones of rejection. They're not zones of support or resistance. It all depends upon where price is. If price eventually comes and breaks this zone, which is initially resistance, it then comes back and we can take a trade off of it as support. Lots of other programs create this line across the chart and label it support or resistance, and that's just not appropriate. Remember that that volume profile, or this histogram, is always changing, and this indicator, as I hope you've seen, recontours market profile intra-candle, and that is essential. If you're trading a 5-minute or you're trading a 4-hour bar, you can't wait 4 hours to get a reassessment of where your value area high, value area low, and your low volume nodes are. Or you might wind up, just excuse me for 1 second, I'm sorry. This is the school. Hang on 1 second. Okay, well, the call dropped. So they're only operational on the right edge where the volume profile is creating it, and they're constantly moving intra-candle, and they're not technically areas of support or resistance. They're zones of rejection. Price does not want to cross the value area low because it's being pushed into the point of control. Doesn't want to cross the value area high because it's being attracted to the point of control. And it does not want to trade through a low volume node simply because traders don't like that price. And I don't know why, and nobody knows why, but that's just the reality. So this is going to act as another area of resistance to the upside as long as price is below it. So this zone is a very strong area of technical resistance when price is below, and this is an area of strong support when price is above. And we don't trade into these. We can trade into them, but the purpose of the platform is to define risk. And we know that if we're going to take a trade into it, it's going to be a riskier trade. And that's really all you can do is to make a risk assessment on the trade and decide on a discretionary basis whether or not the trade is associated with too much risk. That's market profile in a nutshell. Now, what I have to add to market profile now is the market delta. Now we're going to hold off on sending it out because there is a glitch in it, and Sergio is going to fix it. But everybody who has the platform is going to get it. We're not holding it up. I'm trying to find it. Hold on 1 second here. Here it is, the delta. The delta is going to be in panel 1, and we're going to put the volume hammer in panel 2. I'm sorry. Let's see if that works. I'll fix the chart. The delta is really a nice addition. Obviously, it's in the wrong place. So the delta has got to go into 2, and the volume hammer has to go in the new. Oh, I have to do this again. This is just a inconvenience of this. So now the delta goes in 2, and the volume hammer is going to go in 3 in the new panel. Oh, here we have it. Now you can see the delta is flat. This data is not stored. We have to go to the right edge, and we can see what this is telling us on. Now we do not like to use data from our trading chart, but this delta from our trading chart actually has nice predictive value as I've seen it, and this tells us that there's 1,420 excess sellers over buyers. And it gives us, again, an assessment of risk on this trade. And all it's doing, I'll show you exactly what it's doing here. Oh, here we go. I got it. You see the ask and the bid? It's simply taking the ask minus the bid and giving us whether there's more buyers or more sellers. That's all it's doing. Nothing more complicated than that. It's making it a continuous assessment of which type of trader is in excess. It's not an assessment of executed trades. It's an assessment of are there more sellers sitting on the dome or more buyers sitting on the dome? And it does help us determine price direction, especially when we have the moving average over time and we begin to see a nice bias. There's the 0 line. Now when it's sloped to I was not sure whether to make this where it's always green above the 0 line and always red below, or green when it's sloping up and red when it's sloping down. But what I decided to do was to make it red when it's sloping down. But our bias is always going to be the upside when this is above the 0 line. So you have to be careful when the excess of buyers is beginning to fall. But that's all the delta is. The delta is simply the delta between the number of buyers and the number of sellers that are present on the dome. Now, we're going to go to the 3-line indicator because that ties in with volume. Now, we used to have 3 lines, but we got rid of the stochastic line when we found that the stochastic gave us no additional predictive information. So now the 3 lines become a 2-line, but we still call it the 3-line indicator. Now, unfortunately, I have to redo again all of the all right, we'll leave it down here. Actually, let me move it just to make it easier to look at. So the 3-line is going to be in 2, and the delta we'll put the delta in 2. We'll put the 3-line in 3. I'm going to put the volume hammer in 4. Okay, now this is making a multi-time frame assessment. The upper line is the multi-time frame assessment of momentum and does not use any data from your trading chart. The lower line is the multi-time frame assessment of order flow and looks at nothing on your trading chart. This looks at your two higher time frames, and it looks at momentum on the two higher time frames, and all it's doing is looking at a proprietary MACD, whether you cross to the downside and the signal line is the MACD line is moving away from the signal line. When that's occurring on both higher time frames, this line is red. When it's occurring on just your longer term time frame, the line is orange. When the MACD line is crossed to the upside and moving away from the signal line, just on your longer term time frame, you got blue. You can't see the arrow because it's blue. And when it's on both time frames, it's green. So it's giving you a strong directional bias. You can see throughout this time period here, our directional bias based on momentum is to the downside. And usually when this happens, but you're aligned to the upside market structure-wise, nothing happens. And you can see why we're locked in this trading zone here. We've got the 15 above the 50, the 50's here. Both the 15 and the 50 are flat. We've got no momentum either to the downside or the upside. And we were looking for a short trade that we simply can't take. We don't have any background bias, which is really important. That gives, and we're going to go over that indicator in a second. Now the lower is above every candle. This is assessing the absolute delta of every candle. But what we created, and I hope this isn't, it shouldn't be that complicated, is this is the moving average of the delta on the two higher time frames. So when the moving average of the delta is to the downside on your two higher time frames, it's red. And because this is not looking at the absolute number, it's looking at a moving, it actually creates a moving average line. That data stays. When the higher time frame delta only is to the downside, you've got orange. When the delta moving average to the upside is an excess of buyers in a smooth moving average to the upside, it gets green. Highest term time frame is orange. The best time to take a trade is when both multi-time frame assessment of momentum and order flow are in the same color. But you have to have the market set up for the right trade direction. Here, we're looking for a long trade. So we just have to sit. We can't trade. Right now, we're adding specificity to the trade. And this is what creates our, I believe, a very, very high win percentage if we trade with this. Now, let's add some more. Let's add the background bias. The background bias, for some reason, I think is the most difficult to understand, but it's it's really a powerful indicator. Because everybody tells you you have to trade multiple time frames. And you do. If you look at a single time frame to try to trade, you're going to wind up taking losers. Because what you want to do is you want to trade in the direction of your two higher time frames. And remember again, this information the background bias is not using any data from your trading chart to determine a direction. It is using all data from your higher time frames. Now let me find a place where we get a nice trending market. Here's a nice place right here. And let's just take a look. And this one, we're going to have to globally track this so you can see what's going on. Because it goes from one color to the other. So let's globally track here. And let's globally track here. So now we're global tracking. Now, the background bias turns green when the 50 on the higher time frame is green, when the 15 on the higher time frame is green, price is above them both, and you get a technical break of all resistance. So it's hard to make an assessment here on a look back, but here is where you get green. You're breaking above this pivot, and actually you break above it here, and that's what background bias is looking at. You know, this is a half-half close above, and the background bias as an independent indicator is assessing this as a pivot break. So you're getting this green telling you that you have resistance to the upside broken, the 50s cross to the upside on your higher time frame, and the 50s cross to the upside. And it's also occurring on your 13 range. You're trading a 5, you've got that on your 8, and I'm not going to drag over the 13, but the 13's in the same position. That's your best long color, because you have got all of your higher time frames trading in the same direction as you are. And that's what you want to do. That's the predictive value of background bias, is you want to trade in the direction of your higher time frames, and you also don't want to trade into upside resistance. And this tells you that. So when you trade with background bias, you don't have to look at your higher time frames. Now the blue occurs when the 15 is yellow, but everything else is the same as when it's green. So the blue is telling you that the 15 on the higher time frames is yellow. So your bias is still strongly to the upside. But you don't have a green modified 15. So you have a riskier long trade when the background bias is blue. Now, when the background bias is our third color, so you look at this move to the upside right here. If we globally track this right here, it's not giving us an exact back look at market profile, but we've got a tremendous long trade here. The 50's green, the 15's green, and we've got a great trade to the upside. Now, here's the color. You get this color when the 50 is green and the 15 is green. I'm going to write it out. So the 15 is green, the 50 is green, but the 15 has not crossed the 50. The 15 is still below the 50, and since we're looking for that 15 moving average cross, that's really important. And again, decreases the risk of the trade. When you're green, you've got the same situation, but here the 15 has crossed the 50 to the upside. And then when you get the light blue, this blue, you've got the 15 yellow on the higher time frames. And the 15 has crossed. So each one creates a risk assessment for you. Here you're trading with variable long-term momentum, potentially not with you. But the 15's crossed the 50 to the upside, the 15's green, but your 15 is yellow. The market is not trending to the upside as well as you'd like it, but clearly your bias is absolutely to the long side. Here, the 15 and 50 is green, and the 15 has crossed the 50. You want that trade. Here, the 15 is green and the 50 is green, but the 15 hasn't crossed the 50 yet to the upside. So there's a more associated risk. So each of the colors other than green are slightly riskier trades to take. And the green background color is the color where you're really looking for to take a long trade. That's where you're going to get your best trades. Now, when there's no color, that means there's no multi-time frame alignment at all. And if you take a trade, you take it at your own risk. That's going to be the riskiest time to trade. And sometimes you can see there are long portions of time. And usually, if you look at price during the periods of time where there's no background bias, price is extremely choppy and doesn't trend unless there's a multi-time frame alignment. That's really the key. When the multiple time frames align, price trends. When multiple time frames don't align, price tends to chop. Now, again, you can trade without background bias. But if you do, you're trading during a very, very risky period. And the platform is doing its job. It's giving you an assessment of risk. And if you want to take a conservative trade, you won't trade when there's no background bias. Now the red, we'll look at the down, but the down colors are exactly the same as the ups, but I will review them because I want everything to be clear. When you're pink, well, pink's by far, obviously, the best short. That's when your 15 is red, your 50 is red, because you're on your higher time, and the 15 has crossed the 50, but it's not to the upside, it's crossed it to the downside. This is where you're looking for you're just looking for an entry and a trade short. And you can see how you just rarely get chop when background bias aligns. Now, this week, we have not seen much background bias with any kind of associated volume. Now, here is the other down color, and here's the same analogy. Here, is where the 15 is red and the 50 is red, but the 15 has not crossed the 50 to the downside. So this is trading short with a little bit more risk because the 15, although it's heading down, hasn't crossed the 50 to the downside. And then our light pink right here is where the 15 has crossed, but the 15 is yellow. And those two higher time frame yellow 15s, you see how the market tends to move sideways. You've got a short bias, but we don't like to trade this 15 when it's yellow. It's really telling us that there's no trend. And you can just see from a look back that if you really want to take the most conservative trades, you're going to trade a pink background bias to the downside, or you're going to trade a green background bias to the upside, because you're moving in the direction of the two higher time frames. Your 50's up, your 15's up, and everything is aligned. You can trade this color, but you know this is slightly riskier. That's the way your most conservative trades mature. And what you're doing is looking to take the trades in the most conservative environment you can. And you get some great trades and we have two separate indicators that look at volume to really stress how important it is. Now, if we don't trade with an oscillator, what is our overbought, oversold signal? Now, I'm telling you an oscillator does not work. And I'm going to show you what it is. And that's our moving average analytics. RL, moving average. And then when I'm done with this, I'm going to tell you what we're going to be doing. And it's really something that's never been done before, I believe, in history. And I don't get histrionic often, but it just hasn't been. Now, the moving average analytics are in the upper left-hand corner. And what they do is they tell you the slope of the 50, which we don't really. You can use it because if you're looking to take a trade and you want to see if the 50 is about to roll, you know, it's not in degrees, but you get used to this. When it's around 0.1 and 0.2, you don't have much slope on the 50. The 15, the color here will turn red or green before the actual indicator does. So you can get an early indication of a change in color, but we don't look at it that much. It's really not particularly important. This is total volume traded for the day. Just gives you an idea of whether you're in a low volume market or a moderate or a high volume market. From minute to minute, from trade to trade, it also is not important. Here's what's really important to us. It's the MA diff. And that we did find, there's a direct association between the MA diff and the success of a trade. Now, the MA diff is simply the distance between the 50 and the 15. As this widens, the potential for a successful short trade begins to get smaller. Now, optimally on a 13 range, we want this to be 13 ticks. It doesn't mean you can't trade it at 15 or 16. All it's telling you is the optimal trades are going to occur when the distance between the 50 and the 15, both to the long side and the short side, is 13 ticks. On crude, where we trade in 8 range, we look for the MA diff to be 18. We trade in 8 range. Now, I give crude a little more leeway because it was very tough for us to decide whether it was 18, 19, 20, or 21. But here's the thing. These aren't absolute numbers. If you get a nice trade out of consolidation, and we're really not going to go into candlestick formations, you can trade it with an MA diff that's bigger. But on a single continuation trade, which you still can take, if you have all these other, remember, this is just a single independent variable. If you have all the other independent variables moving in your direction, then this is one you can extend out on. But optimally, you're going to get an entry and a nice runner when you've got your 15 fairly tight to the 50. That's where you're going to get your 10, 12, 13, 14, 15 tick trade on the E-mini, and when you're going to get your 20 and 25 tick trade on crude. And what you want to do is just get on, optimally, you don't want to get a winner, you want to get a winner that runs. Nothing can guarantee that, but you're going to get a better opportunity to get a runner when the MA diff is 13 on the E-mini and 18 or less on the on crude or any 8 range instrument. Now, if you're trading a 3 range, then it's going to be 8 ticks. And if you trade any other instrument, we'll calculate the MA diff for you. We'll have to go back and look at it, but we have an awful lot of data, and we'll tell if you trade a 4-hour, we're going to have to go back and run 2 years of market replay data, and we're going to have to tell you where the MA diff is on a 4 range chart, a 4-hour chart. So that's what we use our analytics for. And again, it's providing us with more rules in order to optimize a trading entry. It's going to prevent us from taking some trades and filter out some winners. But what we're looking to do is to filter out all of the losers. And that's the goal of day trading, is to trade with specificity. It's not to grab every winner, it's to sidestep every loser. And you can see right here on this short trade, the MA diff, I believe, is probably big. It's 25 ticks. This is just not a continuation trade we would take. The likelihood of a winner here is not high, but it goes. So by our standards, we would hold off on taking this trade. But we would catch this, so we would get two nice moves. And we would let this trade go because it's oversold. Now, let's go to our next indicator. And it's the quant lines. We have a whole gallery of them, and they're each different for each market. So we need to find the quant ES, which is right here, and we have to make sure that that's in 3. So we have to push everything down. We have to push the delta to 2, quant 3, the 3 line to 4. It's not going to work, but this will allow us to evaluate what we're looking at. Well, I guess it doesn't. Let me. Oh, hang on 1 second here. I just got to take care of that. I just have to reformat the chart since we're building it. I want to leave everything in. I don't want to take each one out. So at the end, we're going to have a full chart, and then we're going to look for entries. Okay. So on the indicators, we're going to have the delta in 2. We're going to have the quants in 3, which we do. We're going to have the 3 line in 4, which we do. And we're going to have the volume hammer in 5, which is our new panel. And that'll do it for us. Oh, my God. Excuse me 1 second. Okay, now this is a really, really important indicator because we know that markets correlate. And really what takes place in the course of a day, and let's move to the right edge. You can see how choppy the market is right now. It's got no volume whatsoever. And we are very, very happy to be out of it and gone. But it's not going to trade with any kind of authority at all. And we know that certain markets go down when the E-mini goes down. Let me just preface it by saying this. What the institutions do is they rotate their money from asset class to asset class throughout the course of a trading day. I mean, there's an institutional rotation of money. And that's why the market goes down. That's why the market goes up. That's why bonds go down, notes go down, precious metals, currencies. That's why they rise and fall in price. It's the institutions that do it, certainly not the commercial traders. So what we're looking at here is when the E-mini goes up, we know that the correlative markets that are just, we can know for sure, is the Russell 2000 index goes up. And we know that the NASDAQ goes up. And we know that the Dow goes up. Now, the only important thing about these positive correlative markets is that they move in the same direction as the E-mini 70% of the time or greater. If they moved in the same direction 100% of the time, our quant lines would be perfect. So that means in math, they have a correlation coefficient of 0.7. And then we also know that there's certain markets that have an inverse. They move in the opposite direction, or they inversely correlate. And those markets, two of them are Treasury notes. Bonds. Certain currencies. And certain precious metals. And basically what you're looking at is this. Risk on. And risk off. So these lines, there's 3 markets in each line. And these are doing a moving average assessment. It's a proprietary moving average. Every market that correlates moves at a separate speed. Which is one of the real difficulties we had when we first released this indicator. We didn't have all the markets set at the appropriate speed, and it was a real nightmare. I mean, these lines were just dancing around, and they couldn't get any footing. So we had to smooth them and slow them and create the right moving average. So what these markets are telling us is essentially money flow. Is risk on or is risk off? When risk is on, you're going to see these quant lines tell us that money is going to flow into the E-mini and its correlative positive markets, and we're going to look for green, green, green. When risk is off, it's going to flow out of the E-mini and its inverse correlative markets, and we're going to see red, red, red. Now, when the markets, when the correlative markets trade like this is when you're going to get chopped. Now, remember, these lines do not look at price on your chart. So they don't turn green because price goes up. Price goes up because they turn green. The multi-time frame assessment of momentum doesn't look at price on your chart. Price moving up doesn't turn these lines green. Price goes up because they're green. So we know the cause and effect here because we're not looking at anything that assimilates data from our trading chart except the delta. So if we look at a really nice period, right now the market's been really pretty choppy. I mean, even right here, we didn't get all 3 quant lines in our direction, but this is the quant line 1 is the major quant. The reason it's the major is these are the 3 markets that correlate the tightest. These have really high correlation coefficients. And that's why I'm always looking to trade in the direction of that major quant. I'll take a trade without it, but it's always a riskier trade. Line 3 is the intermediate quant. And these have the second tightest correlation coefficient. So if you have the first and the third, you're in pretty good shape. take a trade in the direction that they're indicating, given everything else. And line in 2 in the middle has the weakest correlation coefficient, but it's still greater than 0.7. So it's really important to watch these lines. Now, a counter trend trade, and I don't want to go really into that particular aspect of it, you're going to trade in the opposite direction. A counter trend trade is making the assessment that you're catching a change in direction. And you're trading against indicator analysis because the indicators are going to catch up with you later. And I don't really want to go into trading methodology. I simply really want to go into what our indicators mean. But when you're taking a trend trade, you want to trade in the direction of our quant lines. So there are 9 correlative markets on the E-mini. There are 6 on bonds and notes. And there are 3 on crude, all the Forex markets, 3 on gold, and there are 3 on most other markets. All the index equities have 9. The Dow, the NASDAQ, the E-mini, and the Russell. Now, I'm just going to tell you what we're going to do and we're working on, which is really something that's kind of revolutionary. When we look here, we're looking at the direction of institutional money flow into the futures market. But what about the cash markets? And what we're going to do is we're going to create cash quants. And we're going to project them onto the futures market. And we're going to look at the direction of institutional money into the actual cash E-mini S&P, into the cash Dow, into the cash NASDAQ, into cash. Now, we're only going to be able to do this on certain markets because there's no cash equivalent of crude. There's no cash equivalent of gold. There's no cash equivalent of bonds and notes. But we're going to do this on all the index equities, on all the index markets, like E-mini, Russell, NASDAQ, and Dow. And we're going to look at the cash quants, and they're going to look at sector analysis, certain major sectors. They're going to look at an analysis of advancing and declining issues by tick, and they're going to look at volume, up or down by tick, and they're going to look at sector analysis and simply the direction of this cash market. And I think our cash quants are going to give us an outstanding directional entry. It is all hypothetical because we haven't built them and we haven't tested them. But that's our next project. Is we're not just going to look for correlative markets in the other futures markets. We're going to look at the cash quants in those markets where they exist. Now let me go on and see what indicators I still haven't put in, and I know there's some I've left out. Okay, I'm going to look at our entries one at a time. This system gives us great entries. And let me just find our first. And they're all smart entries. And a dumb entry is simply an entry that gives you an entry off of some type of indicator confluence based on the price from your trading chart. So let's take a look at the strategy entry first. Now you see we have an FX strategy, but we're going to look at the strategy on our trading chart. Now here's the strategy indicator. Now you can see it's doing a multi-time frame assessment. Now this is, the 13 is correct because we're trading the E-mini. It's making a 3 time frame assessment. It's looking at your 8 range and your 13 range. And 2 and 3 are the upper and lower parameters that are coded in. And here's the strategy entry. It's a really good entry because it's a multi-time frame assessment entry. You see right here, it's a winner. This is a winner. This is going to get you to your first target. Hang on 1 second here. Okay. A winner. Now it's not looking at the quants. It's not looking at order flow or momentum. It's looking at the 15, the 50, and market structure. And you can see how the kind of great entries it gives. Now, obviously, this is an entry that you can't take. Winner. When it gives you an entry in the appropriate direction, it's a very, very powerful entry signal. There's another winner. Here's another winner. This strategy signal really has to be respected because it's a great entry. It's a smart entry assessing 3 time frames for price action and market structure. Now, our next indicator is the consolidation indicator. Now, this is what our algorithmic automated system is looking at. Let me find consolidation here. Here it is. Now, this is simply looking at price action on our trading chart. Now, it's very hard to make an assessment of consolidation at certain times, but it's a smart indicator in this regard. One, you have to be careful with it, and because you have to make sure it's going to give you like this. Like this is 3:08 in the morning, so there's no. I mean, we're not going to be in the E-mini at 3 o'clock in the morning. Let's just take a period of time where we would actually be trading it. Let's go to the morning. Now here's a strategy at 9:32. I don't know what day it is, but the day doesn't really matter. And we're going through the day. Here's a winning strategy entry again at 10:54. Now this is another one. This is an oversold signal, but if you took it, you're going to get your first target. Now here's an entry out of consolidation. Now this red line below and this blue line above, this blue line's obscured by the point of control, and the red line's partially obscured by the 50. But this is a trade at a consolidation based on all the parameters. One of the big complaints that traders have is, when do you trade out of consolidation? I'm telling you, we know when. And this consolidation signal occurs intra-candle. And when you see it, there's your trade out of consolidation. It's a great entry. You just have to take it in the direction of the market. You have to respect price action, market structure. You have to respect the quant lines, but it gives you great entries. And it's taking a trade out of consolidation. There's another trade. Again, you have to be careful if you're trading an oversold market. And now I might have taken that trade because I really like consolidation, and we would have gotten 3 ticks. And on this one, we would have gotten 4. And I would have definitely set this on 3. But you can see the kind of trades it takes. And then our last entry is just our C candle entry. Let me just find it. And then we pretty much have the whole platform. I'll just see if there's anything else in here that I'm missing. Oh, there is. There's one other thing I want to show you. And here's the ABC. And again, we just want to take the C candle entry, respecting all the other independent variables. The important point is, and there are a couple of indicators we're not looking at, and I'm going to add them, is we want to make sure that the candle open is tight to resistance on a short and tight to support on a long. And what we've done is an assessment and determined how far off we want. So we need an indicator to show us that, since that is an important independent variable. So let me see if I can figure out what the name is. But this is a number that a lot of people send me emails about, and I want to show it. Now we had a power entry, we had paint bars. I have about 55 indicators that we've used that we've discarded because they didn't increase the precision of our trading. Now I'll add the range maker, which is an open code indicator. It's nothing proprietary. We made it a little bit better, but it's not anything really great. Oh, here it is, right here. It's the 15 diff, and I'll show it to you. Now, this is only going to work on the right edge. Now, here is our range maker. This tells you the projected close to the downside and the projected close to the upside. Now, unfortunately, I didn't put the right indicator in because it's not showing. Let me find it. It's been so long since I built this platform that I forgot the name of some of these indicators. But this is a very, very important indicator, and I look at it really carefully on every single trade. And you see what we've done. We've tried to define every independent variable present on a trade, allow us to analyze it, and then give us a really good assessment of risk on a trade. Now, I'm just going to put the engulf in. Let me just step back for 1 second. I always like to put in really strong candlestick formations and point them out on the chart. And the RL engulf is this magenta dot that you're going to see. Now, what's strong about this is, and this is sometimes hard to see when you're looking at two charts, is that this candle, now we have no trade here, we're way off support, but the point is that this candle engulfs the previous two candles. That's an extremely bullish signal. It means that the buyers in this candle, they mean business, because they have overrun the sellers in two previous candles. And you can see, although we don't have a trade, it works. The same thing here. This is an intra-candle signal. You can see that again. These buyers mean business, and they overrun the previous two sellers, and the market goes up. Now, what we're also going to do is we're going to create a dot for a tweezers formation. And I don't want to go into explaining it, but it's another candlestick formation. It's not often seen, but when it is seen, it creates a great entry. Now, these trades were tighter to support on this double engulfer, would have taken this trade long. Now, let me see if I can find the one indicator that now we have nothing in this platform that we don't use. If we did, we would have gotten rid of it a long time ago. And I'm not going to show you indicators that we've eliminated because it's just, you know, it's just, I mean, you can have any of them that we've eliminated, but believe me, they won't help you. And our power entry just did not work. It worked for a couple of months, and then it started failing. I want to show this indicator, and I mean, let me show you the safe zone. Now, the safe zone, which I always have to be careful I'm going to put this as default. Somebody asked me this in the trading room yesterday. Sometimes the moving average falls way behind the the trade. Price moves so quickly. So what we did was we created a safe zone. Now this should be, let me just make sure I put the safe zone in right. The safe zone is giving you the buy-sell zone. Yep, it's 13 ticks. It just looks huge for some reason, but this is simply the absolute MA diff. There's your 13 ticks to the downside. That's your best place to trade. And that safe zone is always going to be 13 ticks above the 50 to the long side. So it's a 26 tick space that stays constant, but it's only on the right edge because the 50 is always moving. So the safe zone is always moving. So if the MA diff is way behind on the trade, you're not sure whether you're overbought or oversold, just look at the safe zone. If you're trading right around it, you're good. If you're trading way below it or way above it, that's a potentially overbought, oversold trade. And now I've one more indicator and we're done, and I just have to find it. But it's a very important indicator. Let me look at this platform and find it. Or maybe it's the RL. I don't know what it is. I'll show it to you here. See this 2 that's right up here? This 2 tells you how many ticks the candle open is from the modified 15. Now, on an E-mini trade long, you only what you want to do optimally, it's always jumping above or below, depending upon if the candle's heading down, it's going to be, actually, if it's heading up, it's going to be below. If it's heading down, it's going to be above. It's going to try to stay out of the way of the trade. And what it tells you is how many ticks off the candle body open is from support or resistance. On the E-mini, we would like that to be optimally 3. I love it when it's 2, and when it's 1 and 0, you're trading right off support or resistance. It's great. But that is a clear-cut and important independent variable. If you take a trade that's far off support on a long trade, there's always the chance. Let me find an example. Now, here's an example of what didn't happen. But if you take a long trade here, there's no entry, but that it will come back to support and then continue up. That's why you want to trade tight to support when you take a long trade. Now, on this entry right here, if we were going to take that entry, that analytic would just give us a 1. It would tell us that we're really, really tight to support on that trade, and that really is helpful. Trading tight to support or tight to resistance is really a key independent variable in taking a trade, and one that almost no platforms assess, even though it's a critical parameter. So I believe that's all the independent variables that we've found so far that are critical to analyze when taking a trade. And that is the goal of the software, to try to give us a great risk assessment to get us into low risk trades. And let's just take a look. Let's move the higher time frame out. Now, this was a perfect counter trend trade. And you'll notice the delta was red, already telling us there was an overabundance of sellers, and got 34 ticks on the trade. And this, you can see what I told you, was really a very risky trade, and I never should have taken it. It was a C candle coming off the point of control, so it was coming off of support. Didn't have any background bias, trading right up into resistance, and luckily, I was able to scalp 30 bucks off the trade. So you can see when the trades are great, and you can see when the trades are not so great. Again, too risky here. So I hope that, let me take a look at all the questions on the platform and go over everything and see if there are any questions. But that's it. Now we're going to make a few modifications in the market profile again, and there are a couple of coding errors that I need to go over with Sergio. So we'll probably send it out right after the first of the week next week. Now let me just take this off. Let me take the global tracking off. But what I want to do is this doesn't matter because I'm going to, is I want to color code the volume, and I also want to make sure that our entry. Now here's the one thing I'm going to do just for these purposes is on the volume, on the market, on our market profile. And I'm going to do this on this one only because this is what's set for that buy, sell, and balance intra-candle. We need a 250 contract difference in any given tick to show either a light green, dark green, or a light green, or a light red, or a tomato or red. I'm just going to change this to a very, very low number so we can see the intra-candle buy-sell pressure, and that's called the volume ladder. Now, the volume is so low, we may still not even see it. Let me try to make it even lower. I'll just make it 25 and 50. Let's see. Now you see, we've got that dark green, and that is showing us that even on a down tick, there is an overabundance of buyers on the trade, and that is what we're looking at right now, and that is called a footprint, or a volume ladder, however you want to characterize it. And it doesn't have much predictive value, but here's the way it's supposed to be used, and we're going to leave it in, although I don't see much of it having much use. But let's say that you had a tick value here. Well, I'll make it green. I can't do it any better than this. And this is a strong overabundance of buyers. When price came up, let's say price went down. Well, let me do it this way to make it real simple. I'm going to take this out. I don't want to make this talk too long because I don't want people to zone out. But when price comes up, and then when it comes back down, this zone is going to act as a very weak area of support because sitting in this candle is a tick value with an overabundance of buyers. It just does not have much predictive value. And so there's the potential to take a bounce. But in looking at it and analyzing it, I just don't see that that has much predictive value at all. So that's what the volume ladder or the footprint inside a candle is made to do. Now, some of those candles have the buy-sell numbers in each, and they're just confusing, and they just give you more data than you need. And again, why display data that you don't need and can't use? And this is not much, doesn't give us much predictive power because it's really a support area that's sitting in one tick, and the disparity between buyers and sellers in absolute numbers is not that big. The pivot is really much more important, value area high, low, point and control in these low volume nodes. And I don't really pay much attention to these intra-candle disparities, but that's what it means. So that's our whole platform. So let me see if there are any questions. So at least you know exactly what's going on. The key to what we do is we do a multi-time frame analysis of everything. And when you do a look back on the indicators, if they're green and the price goes up, you know which is moving which. The indicator direction is moving price. The price is not moving the indicators. And that's the problem with a MACD using price from your trading chart. It always goes up when price goes up. An oscillator always goes up when price goes up. These colors do not change based on price on your trading chart. Now, almost always when I have a problem with trading, it's usually almost always my fault. I take a trade with too little volume, like yesterday, or I assume too much risk. Now, I was lucky today on that crude trade, and I am not too heady to admit that when I took this trade, I was really concerned I would open with a loser. I jumped on it. The higher time frames were nice in terms of this trade. Remember, the point of control is an area of support on every time frame. But this is just not a trade. And even though it made us money, should not have been in it. And you have bad trades make you money and good trades that lose money. So you really have to go back and make an assessment, and you can't crow about a trade that made you anything unless it was a really good trade, or you're going to make the same mistake again, and the next time you take it, it's going to really beat you to death. I mean, this market is so unforgiving, and it's changed in the last few years. It's become a lower volume market, and it's become more institutionally driven with algorithmic trading, which has almost completely taken over crude oil. The E-mini is our best trading instrument because we've got 9 correlative markets, and we're going to add our cash quant lines in the next few weeks. And it may be that that's what we ultimately wind up trading. And it's really tough to bring back the NASDAQ or the Dow or the Russell because they trade with so little volume. But the Russell's going to be moving back to the CME and off the ice. And when it does, maybe we'll get 250,000 contracts on the Russell, and we'll trade the E-mini in the Russell. I'm not wed to crude oil, but crude oil has really become an institutionally driven instrument, and it just blows down and just gets fired up on signals that it just goes against the grain of all the indicators because the institutions just flip the switch on a computer and up it goes. So let me see if there are any questions. Okay, hang on a second here. Let me go to the top. Okay, Brian. Yeah, call Sergio. He'll take care of that. Okay, hang on 1 second. Thomas, you have to give me a time on that. The dark cloud cover on crude. Now, it was at 9:31. Let me look at 9:31. Let me look here. 931. I don't see a crude entry, Thomas, at 931. And Thomas is a great, really understands how to read candlestick formations, but I just don't see that. Let me come back to that question. Great trade, David. Great trade. Okay, Pamela, if the ES was above your green line, why didn't you go long once closed over the faster green line? I hope that you see why I didn't take a trade, given all the information. If you still have the question, if you're looking, if you have a question, you got to give me a time for the entry. And what I'm going to do on this chart is I'm going to remove all of the drawing. So now it's a clean chart, so we can actually see it. And if you have a question about any entry, just give me a time so that I can assess it easier. Because it's hard for me to give you whether I should take a long when I don't know exactly what time it is. David's taken some great trades. Okay, Marish, is there any significance to the colors in the chart pane? Well, that was at 10:38. Hopefully I've answered. Yeah, this is all recorded. Hopefully I've answered your question. Okay, the 8 range and 13 range are the two higher time frames we use on the E-mini. And all they are is we use the two higher fib numbers. If you trade a tick or a range chart, let's say you trade a 5 range, the two higher fibs are 8 and 13. If you trade an 8 range, your two higher fibs are 13 and 21. So let's say you trade a 377 tick. Your two higher time frames are 610 and they're 9, I think they're 987. So that's how the logic of the indicator works. Now, if you don't trade a fib, let's say you trade a 4 range, it will default to a 5 and give you your higher time frames as 8 and 13. And the difference is very negligible. Now, if you're trading a time, if you're trading a 3-minute, your two higher time frames are 9 and 27 minutes. 3 times 9, and then 3 times 3 is 9, and 3 times 9 is 27. So if you're trading a 3 Renko, it's going to go again to the two higher fibs. It's going to go to 5, and it's going to go to 8. So those are the time, that's the multi-time frame analysis that's in the logic of background bias and in the logic of the 3-line indicator. That's how that works. So you don't have to, all you have to do on the 3-line is just put in your highest time frame. And it's going to be your second fib number or your longest time frame. So we show you how to do that, or we'll just make you a template. It's very, very easy to do. Marish, it does not. If you trade, it depends what chart speed. If you want to create a 5-minute or a 30-minute, and you're trading, say, a 5 range E-mini and an 8 range crude, I think those are too longer. Those time frames are too long to call the direction. We found that the two higher fib numbers are really what are really the best. And if you're trading a 3-minute, your 9-minute, and your 27-minute. If you're trading a 5-minute, your 15-minute, and your 45-minute. It's really the factor of 3 or the higher fibs. And you know what? You can see the results in the green background bias, how well the market trends. And remember, if we were using a really long time frame, like a 15-minute, like a 30-minute chart or a 5-minute, it may take a long time to create this green. We miss the move. Here, you get to see great trade right here at a consolidation, This is at 9:36, and this was on 5:19. Um, Now, I don't know if I took. I hope I took this trade, uh, but you can see this was a gorgeous trade. I mean, it gave us a one-tick pullback, but you can see the background bias. It went, yeah, seven. We were in this trade. This wick took us out. I remember this right here. This wick came back and took out our trailing stop, and then the trade won 7 3/4 points. So I think that we get great multi-time frame alignment just based upon the time frames that we use. And we've tried everything in terms of looking at the two higher time frames. And the two higher fib numbers or the three or that multiple of 3 for time are really, I think, going to get you your best trades. Okay, Maurice, I hope I answered that question for you already. Thank you, Thomas. We're going to have that, Brian, soon. I mean, I got Sergio working on 100 things, but we're going to code that volume. That's what we're going to do. What I may do is have him just correct some of. There's a couple of errors in the delta in moving average here, and then roll that out so everyone can have that, because I want everyone to get as much of an edge as possible. And I believe that this indicator does help you. And then our next step on market profile is going to be to color code the bars to give us an even better edge. And he works really quickly. He's just a few days away from rolling out our NinjaTrader 8 version, and he's about a week and a half away from rolling out our Sierra Charts version. And then he's going to be working on our our TradeStation version. So it's going to be very soon. So we are going to color them. Always. Anytime that we have a color coding, we always get, like, we have the ability, you have the ability to turn the whole histogram off. For traders that want to simplify their chart, and if there's an input like that you see on the indicator system that we don't have, we'll put it in there for you, because that's a simple addition. And if it annoys you, then it probably annoys other traders. So if there's a color or something that you believe is too much and that doesn't help you trade, we'll give you an offset for that, and we'll take it out. We'll take it out. That is not a problem here. We've broken the program down to only indicators that we think have value, and we've made this 3-line, 2 lines. But if you don't want to look at that volume analysis, and eventually when we color code the volume bars, you don't want to look at that, you're going to have a default to turn those off. That's this number right here, Frank. That 2. Now we're still in that same candle, but you can see right here, if you look at the chart, here's the open, here's the modified 15, and the candle body open is 2 ticks off. So you never have to get it. I never have to sit there with the ruler and scale it, or never have to guess. This number is always going to tell you how far. Now remember, there's sometimes where we're going to trade off the value area high, then that number isn't important. But when we're trading off the modified 15, the number's a really critical number. As we get a little more sophisticated and we have new areas of support and resistance, what we're going to trade off of, but this is a critical number, and we can't have it look at the candle body open of multiple areas of support and resistance. We'd all go crazy looking at it. But most of the time, that 15 is what we trade off of. Thomas, I would put them all in your charts. All of these indicators are here. Here's the consolidation signal. Here's the double engulfer. Here's the consolidation signal. Here's the C candle signal. And you see here, this was just a perfect entry that failed because of volume. And it really didn't fail. This was the trade that came back 6 and then went up to make a 1.5. But you just have to trade with good volume. But I would put them all in because I watch those system-generated signals, and they generate very, very nice entries. I really like the strategy entry because it's a multi-time frame assessment entry, and it's a very good entry. As long as it comports with our 15 and our 50, and it sets up nicely in terms of market structure and price action, it gives you a very, very nice entry. Sure, I will do that, John.